In the chaotic financial winter of 2022, the global markets experienced a violent, unyielding contraction. We watched as trillions of dollars in market capitalization simply evaporated into thin air. Technology stocks, which were once the undisputed darlings of the modern era, were absolutely decimated. Retail portfolios bled out in the streets. Panic became the dominant psychological state, and the media relentlessly broadcast what felt like the end of the financial world as we knew it. But while the masses were paralyzed by fear, a completely different game was being played in the shadows. The elite financial architects, the apex predators of Wall Street, were executing one of the most calculated, ruthless wealth transfers of our generation. Let's deconstruct exactly how they did it.
The S&P 500 took a brutal 18.1% hit that year. And look, this wasn't your standard run-of-the-mill market correction. It was macroeconomic destruction. Under the intense pressure of persistent inflation and historic Federal Reserve interest rate hikes, the cost of capital, which had basically been zero for years, just skyrocketed. Broad market indices were systematically compressed with a kind of violent efficiency. But the tech-heavy NASDAQ? It plunged even further, booking a staggering 33% loss. We hadn't seen an annual wipeout like that since the 2008 global financial crisis. Suddenly, growth companies living on cheap debt faced a total existential crisis, and valuations of the most prominent companies on the planet were slashed in just a matter of months.
But here is the most chilling statistic from this entire period: $15.41 billion. That represents the cumulative net retail purchases in Tesla alone during the lead-up to the crash. For the average individual, the emotional pain of watching that hard-earned capital bleed out day after day, it became unbearable. Cognitive biases took full control. The sheer fear of losing everything overpowered any rational assessment of long-term intrinsic value. The result was a massive, terminal capitulation.
Act 1. The crime scene. The capitulation.
To really grasp the scale of this structural discrepancy, we have to look at high-frequency flow datasets to reconstruct the precise environment that finally broke the resilience of everyday investors. If you look closely at the December 2022 data point from EPFR Global, a system monitoring a massive $55 trillion in assets under management, you'll see something shocking. The 4-week moving average of retail-driven outflows hit a mind-numbing $65 billion. That dataset captured 26 consecutive weeks of negative retail equity fund outflows. And get this, that exactly matches the capitulation extremes we observed during the 2008 banking collapse and the 2020 pandemic crash. The public was hitting the sell button at the exact wrong time.
Take a look at the forensic footprint of that Tesla retail capitulation. A 37% peak drawdown, completely driven by year-end tax loss selling and historic forced margin calls on retail accounts. In just 3 days, we saw 700 million shares change hands, representing 25% of Tesla's total public float. The daily relative strength index actually dropped to 17, which is a massive indicator of extreme, non-fundamental seller exhaustion. Essentially, retail investors were forced to liquidate their favorite assets at historical lows, transferring their exposure directly into cash.
Act 2. The hidden perpetrators. The accumulation.
Here's the thing. When someone sells, someone else has to buy. While the public was busy liquidating their positions, the smart money was silently accumulating. Elite algorithmic managers don't operate on emotion. They operate on cold, unfeeling mathematics. They recognize that a panic isn't a reason to flee, it's a generational opportunity to acquire premium assets at a steep discount. So how do we know exactly what they were doing? Because they're legally required to leave a paper trail. SEC Form 13F filings are mandatory corporate disclosures that reveal the quarterly long equity holdings of institutional asset managers. While the lit public markets displayed a synchronized retreat from risk, cross-referencing these legal filings with those retail outflows exposes a highly asymmetric, structural phenomenon happening entirely in the shadows.
Just look at the precise actions of Citadel Advisors, who, by the way, locked in $16 billion in net profits that year. In the first quarter of 2022, as macroeconomic risks started to emerge, Citadel systematically reduced its long exposure in Apple common stock by 42%. But then, in the third quarter, precisely as retail capitulation accelerated, they executed an aggressive reaccumulation campaign, increasing their position by an astonishing 1,074%. They acquired over 5.74 million Apple shares at the exact moment retail investors were bleeding out.
The contrast here is stark and undeniable.
On one side, you have the retail cohort, driven entirely by emotional panic, forced margin liquidations, and year-end tax loss selling. On the other side, institutional desks, executing smart money concepts and algorithmic reaccumulation. The masses view a market crash as an absolute disaster. The elite view it as an inventory clearance sale, allowing them to build a generational low-cost basis.
Act 3. The Weapon, Liquidity Engineering and Dark Pools.
Now, you might be wondering, how exactly is this massive wealth transferred without immediately driving up the price of the stock? Well, to acquire massive positions without moving the market against themselves, billionaires actually require your panic. Let's dissect the multi-step mechanics used to harvest these retail losses. It begins with order blocks. These are specific price zones where large market participants strategically place massive orders to absorb momentum. Institutional algorithms are specifically designed to exploit the highly predictable behavior of retail traders who routinely cluster their stop-loss orders just below major technical support levels. The blood in the streets provides the exact liquidity needed for their algorithmic accumulation.
This leads into a ruthless 4-step execution sequence. Step 1, liquidity engineering. The algorithms execute short-term selling pressure on lit exchanges to deliberately trigger those retail stop-loss orders. Step 2, the liquidity grab. The triggered stops suddenly flood the market with highly concentrated sell orders. Step 3, internalization. Market-making desks absorb this immense sell-side volume completely off exchange. And finally, Step 4, institutional block allocation. These internalized long positions are systematically transferred to long-term institutional buyers at distressed prices.
The internalized reaccumulation index formula proves exactly how the mathematical reality of dark pools matches completely mask this institutional demand. Public exchange pricing registered the panic-driven retail market orders, which fueled the narrative of a massive crash. Meanwhile, dark pools were quietly clearing the institutional block purchases, right at the midpoint of the bid-ask spread. That created a temporary pricing discrepancy that entirely favored institutional accumulation.
Act 4. The Verdict, the Wealth Transfer.
Based on the irrefutable evidence in these SEC filings and high-frequency flow data, we really have to redefine the very concept of market efficiency. The traditional view that asset prices instantly reflect all public information is mathematically challenged by the deliberate use of pre-trade opacity, hiding true buy orders from the public eye. 42.0%. Just absorb that chilling figure for a moment. That is the percentage of consolidated U.S. share volume that was routed off exchange during this period, moving through over-the-counter and alternative trading systems. It was deliberately routed into the dark. By doing this, institutional buyers constructed generational long positions with minimal upward price impact on the public lit exchanges where everyday retail investors operate.
And the trap was perfectly set long before the crash even began. Notice the massive peak on the far right of this historical data for household equity and bond holdings. Retail investors were actually holding their highest ever proportion of equities, nearly 30% of total assets, right before the 2022 contraction hit. They were structurally over-allocated to stocks, heavily exposed to the exact sectors the institutions were preparing to sweep.
The evidence presented in this explainer is absolute. The 2022 technology downturn was not a symmetrical retreat from risk. It was a highly structured, algorithmic transfer of wealth. Elite managers basically engineered an extraction of capital right from the retail cohort at the absolute trough of the macroeconomic cycle. The wealth was not destroyed. It was simply transferred from the emotional to the analytical.
Which leaves us with one final unavoidable question. In a market engineered by algorithmic liquidity sweeps and pre-trade opacity, are you trading the asset, or is the market trading you?